everybody. Welcome back to the Rob Review. I'm your friend in success, Robert Morris. Glad to have you back as we talk about becoming a stock market CEO, investing like a CEO. And, I'm going to go ahead and apologize in advance. I'm pushing through a cold, so if I cough on camera or if my voice sounds weird, it's just the way it is tonight and for the next couple of episodes, probably. So, investing as a CEO, we've really dove into building out dividends and really looking at your investment portfolio from the idea that I want to build out a business with it, a business portfolio where I get profits from the business just like a CEO would from their business, okay? Now diving further into it, we want to talk about investing and start to kind of get into trading, because I believe that if you're really going to become a CEO in the stock market, you're going to want to not just invest for the long term, but also take advantage of short-term movements in the market, both on the stocks you're investing with and other stocks that are out there, so that you can compound your money at a faster rate. You want to get the most out of your money because you work really hard for your money. I know you do, because I work hard for mine. And everybody that looks at their money with a long-term perspective usually has a really good grounded foundation in, I don't want to waste what I've worked hard to earn. And because of that foundation, you can turn yourself into a very profitable trader. And that's what we want to talk about, is the foundations of both investing well by reading chart and then using that chart reading to become a profitable investor and trader. And there's really a foundation to that, right? And so I'm going to step over here to my next set and we'll go into the foundations of it. All right, so foundational principles of profit. This is what we're going to spend the next couple of episodes on, however long it takes. This comes from books I've read, but also just from traders I've talked to that really do well in the marketplace. There's 4 pieces to this, really critical pieces, all right? Mindset. And it's not just a mindset of, I'm going to win. It's a mindset of playing the long game. And we'll talk deeply about mindset. Money management. Yes, that's an important principle. I put that as number 1. But really, mindset and money management come secondary to discipline. 100% discipline 100% of the time. You cannot get anywhere in the market if you don't discipline yourself. And the discipline is useless without the how-to. Now, how-to is about 10% of the equation. The money management, the mindset is really 90% of it. And then 100% discipline 100% of the time is what I've been taught to think about when it comes to market success. Okay? Now, each piece of the puzzle has to be there. And each piece of the puzzle deserves study and long-term analysis and planning to grow yourself into that. But none of it can be built into anything without focusing on the how-to first and getting that out of the way. And not out of the way like, oh, I'm going to learn it and then forget it. Getting it down to the point where it's a foundational principle of what you do. You need to know the how-to, like you know your address, like you know your name. See, it becomes ingrained in you, because in the market, when you're trading, okay, when you're in the zone of trading, okay, you take yourself out of the zone by having to go and look up, okay, what does this pattern mean? Or what is this thing that I'm seeing here on the charts? Or what should I do with? You want to be in the zone. And everything in the market really happens fast when you're trying to do it with money. There's a lot of looking, studying, and planning, but the action taking happens quick and in a hurry. Well, it doesn't happen in a hurry. It happens quick and in a manner of precision effectiveness. I look at it, or have been taught to look at it, like the way troops enter a see, this is a cold working on me. When they go into an action that they're taking at war or at a battle, okay, they've planned, especially the SEAL teams, they've planned that particular action to a T. And they've planned it so well that they're just executing their plan. And they think about and plan for many contingencies. And as should you. And that's where this how-to comes into place, because you want to learn the how-to of the market to the point where you can do it in your sleep. And the real big piece of this is because if you don't know it like the back of your hand, fear creeps in every time and paralyzes you. You know, it's the old adage that a deer in the headlights always gets run over, you know, or bulls and bears live on, but hogs get slaughtered. You know, the idea that you're just never going to make any money in the market if you're stuck in fear. Scared money doesn't make any. So if we don't know the how-to well to where we can execute a plan, trading like a CEO means having a plan and then executing that plan with discipline 100% of the time, right? And the plan with discipline, the only way to build a plan is to be able, the only way to build and execute a plan is to be able to read patterns and candlestick charts well. You must know your Western technicals and candle charts. They go hand in hand. I mean, they're really like a married, beautiful couple that's been together for years and years, ever since Steve Neeson brought candlestick charts to the Western world. He's like the father of candlestick charts. And I've learned everything I know about candlestick charts from going through his courses. And then basing that off of a foundation of already understanding Western technicals. They go hand in hand. And so what we're going to talk about here first is a Western technical crash course. And then we're going to talk about candlestick charts in the next episode so that you can build a plan that you can execute well. Okay? Western technicals allow you to analyze trend. That's the bottom line of the way I look at Western technicals. And then candlestick charts, where they come into play, is they let you see the reversals in those trends. Because we have talked about before, and you know if you've ever researched the market, you have micro trends, macro trends. You have all kinds of trends. You can have a movement on a yearly chart that's stacking up. Same thing on a monthly chart, stacking up. And then as you see that movement happen, what always happens with upward movement? Well, there's always profit taking that pulls it back. Well, you can watch an upward trend and see that profit taking is beginning to take place through knowing candlestick chart reversals. Then you can put yourself in a position to profit from the profit taking and then step into the trend at a place where it's resetting and beginning to go up again. That's the way I look at trends. You don't want to hop in a trend without being able to understand how to analyze charts, because you don't know if the trend's getting ready to end. And that's what most people do. The public always does the opposite of what people that make a lot of money do, because the public sees something going on in the market and everybody's making their money. And then the public says, well, man, this is awesome. Let me jump in. And by the time the public jumps in, generally speaking, the professionals are the ones selling their shares to the public, already have taken the profit. And then the public begins to step into a fear cycle. And then as they're fearful, the professionals step in and they take a hold of what they're selling and begin to profit off of it again. See, that's the cycle that you don't want to get into. You want to be on the professional side. And that comes from a completely unemotional analysis of where the market is. And that comes from Western technical and candlestick chart. That's the way I see it, okay? It's an advantage worth understanding, because as CEO, you want to take your emotions out of the equation to the best of your ability. And now some of that is money management, but a lot of it comes into play with Western technicals first. This is all I can teach you or show you is what I use, right? I use a combination of Bollinger Bands, indicators, moving averages, support and resistance line. And then there's some patterns with Western technicals too. Bollinger Bands, the way I look at Bollinger Bands is probably different than you've ever heard, okay? This is what I've been taught. This is not my thought process. but this comes from very successful traders, okay? The guy that developed Bollinger Bands probably doesn't even talk about it like this. Bollinger Bands are like the oxygen barriers to candle. When you look at a candlestick chart, the next time you're looking at it, look at how candlesticks push. See, a lot of people see Bollinger Bands and they're like, well, how can I use them? Because they're always moving. Well, candlesticks push against Bollinger Bands as they're rising. And then when they get outside the Bollinger Bands, they're usually pulled right back in. And sometimes the trend continues up, but sometimes it reverses. So you have Bollinger Bands expanding and contracting. Within that expansion, you can prepare yourself for a downward move. Within the contraction, a lot of times there's an explosion one way or the other, depending on how the moving averages are moving. And so it's a combination. Moving average lines are the pressure that pushes the candles and drives them up or down within the oxygen of the Bollinger Band. I look at important moving average lines. There's a lot of them. These are the main ones that I use. 2155, 144, 233, 610, 987. There's a few other ones in there. But if you really wanted to only pick a few, I would say the 21, the 55, the 144, and maybe the 233. The way a moving average works is it's a period of movement. And so like 21 moving average is 21 days of movement analyzed to make that line. 55 is 55 days. So the more periods of movement, obviously the less the line moves. So it takes a lot longer for a 987 to go from up to down than it does a 21. And so if you and most charting softwares have this, when you're building your Bollinger Bands, they put a 21 right there in the middle of it, okay? That 21, if you really look at it, it can either go up, flat, or down, right? A lot of times when a 21 goes down and then flat, the next movement is usually the opposite of that, which would be up. Same thing on the back end. When a 21 is coming up and it goes flat, the next movement is generally down. Now, I'm not at liberty to completely say that's 100% of the time. Nothing's 100% of the time in the market. But it's kind of cool to know that at least 90% of the time, maybe if it was only 60% of the time, it would give you an edge, and that's what you're looking for. So the pressure. Go and look at your charts. I don't have a lot of examples today because it just didn't seem pertinent to me to go through example after example after example. But the real piece here to get is that moving averages are both barriers and supports to candle. And within the Bollinger Bands, if you've got a lot of pressure moving and pushing those candles higher, you can tell that if it's coming off the top of a Bollinger Band, that likely the down is not going to last long because you've got so many barriers to go through that as they hit each barrier, the power, the fuel that move has becomes less and less. And then eventually one barrier is going to catch it and hold it. And a lot of times that can be the 144 or the 233. And we can go deep into each of these because there's a lot to learn. But this is the foundation. Drawing support and resistance lines all over your charts. Not so much that you can't see. Maybe 3 to 4 to 5 good lines on every time frame you're going to use. Why are support and resistance lines important? Because the market doesn't generally do new things. And when you really look at it, guys, the market can jump up and hit something and then go down. And if you don't have support and resistance lines, you can't tell that the reason it didn't go any further is because that was a high that it hit previously and has hit 3 times this year, and it wasn't ready to break it. Same thing can happen if it hits it and it's ready to push through, and it's got the momentum to push through, it could be making a new high and you not even know it. But if you were ready, you could profit from it, right? The support and resistance lines, not only in the candlestick part of it, but also the indicators part. The indicators are a part of Western ideals. Indicators are good for indicating the fuel of a movement. I use things like stock RSI and stochastics and MACD and directional movement, all combined with the candlestick chart to help me see the full picture. Is a movement ready to go for a really long time? You don't really know that, honestly, unless you have the indicators, because candlestick charts are only really beneficial when you're trying to analyze reversals or trends and the breakage of trends, which could then be a smaller retracement, i.e. reversal. But the indicators can provide for you an idea of how long has this trend been going on. Okay, well, let's say stock RSI, for instance. What if the stock RSI has a hard floor and ceiling of 100 and 0? But what if you had a support and resistance line drawn where your stock RSI hit highs and lows on a regular basis? And then you, as the person trading this, now have an edge to know, oh man, I have seen this thing start. And a lot of people might be jumping into a trade here, but I'm not going to because it's at the bottom of the scale. So you begin to use all these pieces together to benefit yourself, to both keep yourself informed, but also keep you out of moves that aren't going to last long. Because that is the name of the game. Not trading often, but trading effectively. When I speak to people that make a lot of money in the stock market, especially when it comes to trading, you'd be surprised at, unless they're a day trader, how many of them profit exorbitant amount of money. They grow their accounts by thousands of % a year, but they're not in trades every day. There's a newsletter I get from one guy who last year, he's a fund manager, a hedge fund manager of a very big fund, hundreds of millions of dollars. He did 72 trades last year. Of those 72, 60 were profitable, 5 or 4 were break even, and the rest were losses. Doesn't matter, no, because we're all going to lose money. All of it. Can't stop that. But compounding that 60 every year, getting a little bit better, the return over 10 years is massive. I mean, that's where it comes down to having the edge and really getting into using these indicators to giving you that edge. And then you pair it with Western technical and pair it with candlestick chart, which we're going to get into in a minute. And you're not doing every trade under the sun. You're waiting for your charts to set up to where everybody else is doing maybe a trade that is going to go, the stock's at 100 and it's going to go to 103 and back up on them. You're setting yourself up. You might trade 12 times a year, but those 12 times are times when the stock is reversing big time and it's going to go weeks in your direction, not days. Now, you can profit from days depending on which options you buy. Important Western technical pattern. Head and shoulders, flags, pennants, double bottoms, double tops, wedges. Excuse me. Man, this is cold. All right. I think I should draw some of these for you, and I got some time here to do that. So we'll talk about head and shoulders and flags and pennants, double. There's a lot of other ones, but head and shoulders is one that I see a lot of. And if you get used to seeing both the regular head and shoulders and the reverse of that, a head and shoulders pattern has caused it because you got your head and your shoulders, and the candlesticks can form one And if they don't break the shoulder, it can be a continuation of a trend that's going to be stronger. Flags, a flag pattern. Well, let's just walk over here and I'll draw some for you. All right, so you got your candles. All right, and this is a really poor. That is a flag, okay? When it breaks out of that flag, this is an indication that it's going to go up. The same thing with the flag in an opposite direction. It's an indication of a reversal. And there's a lot more to these kinds of patterns. Pennants, they look kind of like, well, this would be a wedge. All right, and so you got your candles are moving in a man, this cold is getting me. All right, let me just go back over here. Maybe it's not time for me to try and do some drawing. The ability for you to understand how to use these patterns is crucial. And I think you can only understand how to use them if you put yourself in a position to study the chart. And I'll give you some recommendations of some books here in a little bit where, I mean, if you really just study these books, you don't need somebody like me to show you patterns. You can go find them yourself. And finding them yourself is where the learning turns into how-to that you can own. You do it over and over and over again. You know, I would suggest you take each one of these patterns and you go and you find examples, 50, 100, on every chart time frame that you use, till that you ingrain them in your head, point where you can see them without looking for them. And then you're going to use lines on your charts to draw a flag pattern and to draw pennants and to draw wedges and double bottoms and tops. I see all the time. And then within the candlesticks, you can use these patterns to profit. All right? Most stocks follow a pattern that, you know, is set within a larger trend of the market. So you can also benefit from understanding how the market is moving with the Western technicals. It doesn't, see, that's what I'm saying, it doesn't matter. Whether it's your individual stock that you're trying to figure out a place to buy, whether it's seeing how a market is going to move for the rest of the year or for months, the plan of what you're going to do comes from using the market trends. And you can only analyze those with Western and candlestick put together. All right. Now, the next time we get together, I'm going to dive as deep as I think you need to know to be able to begin your learning of reading candle charts. Because here's the thing, guys. You can get so in the weeds with this stuff that you would know so many patterns, or you can get precise with stuff that shows up all the time, the basic, to the point where you know them without looking them up. Which one would you rather have? Would you rather go deep in the weeds, or would you rather have the basic and not be burdened with overeducation and too much information and, you know, analysis paralysis kind of deal? See, I'd rather be the guy that has, these are reversal candlestick patterns. These are Western technicals that I can use to analyze together. And I'd rather take those and go and look for them and not worry about the other stuff that doesn't show up as much. That's me. And so what I want to do is tack this on as a second piece to this. So once we've talked about Western technicals as we have, now you can take and you can add in the candlestick chart and the reversal pattern with a nice foundation, and you can step into the market with confidence, whether you're a beginner with zero experience or not, because all of us start somewhere. We all start somewhere. And the market is going to hand you your head on a platter at some point. It's going to do it more than just a few times, regardless of your experience level. So it's best for you to step into the market with the most confidence you can and just get going. And so that's where the zero experience comes in. I don't care what your level is. I can show you enough about candlestick. I've shown you enough about Western technicals that although you haven't seen a single real pattern, you know that this is what Ravi uses all the time. So let me go and let me look up how it looked, and then let me find it on my own chart. I hope you find this helpful. I probably take time to go deep into, or not deep, but, kind of take each one of these Western technicals in later date and do a video, a piece on each one. That way we can look at some stuff together and all that. But when it comes to Western technicals, since you stayed until the end, this is the best book I've ever read on technical analysis. I don't even know if you can find it anymore. I got this from my dad. I kind of commandeered it. It actually came, this is how old it is, it came with a CD-ROM that you would go through and you'd take the tests on it. But Martin Pring is kind of like Steve Neeson is to candlestick charts, Martin Pring is to technical analysis. This will give you the basic, and you can go and learn from there. Now, if you stick with me to the next one, the next episode, we're going to go deep dive how to read candlestick charts with zero experience. Lee, take us away.